Hi, everyone. I'm Shimon Shkury with Ariel Property Advisors. And together with me today is my partner, Victor Sozio. Both of us are going to talk to you about the New York City market in 2020 and what might happen in 2021. Hi, Vic. How are you?
Hi, Shimon. I'm good. Good to see you.
Good to see you. I know we speak a lot, but we don't always see each other. We see each other actually now twice or three times a week in the office, which is pretty good. It's a pretty good thing. 2020 has been a tough year, not a secret. We had only $13 billion worth of real estate investment sales transactions. And as you can see from our graph and from what we've accumulated over the years through our systems, this is really somewhere in 2010 to 2011 levels. It really feels back like 2010, right, Vic?
It does. Some parallels to 2010.
Right. And if you look at the cap rates, they're definitely ticked up a lot compared to the year before. The Bronx is at 6.5%. Brooklyn is at 5.17 on average. Manhattan, 5.04 cap rate. We haven't seen an average like that, I think, since 2009 and 10. So this is really, really interesting. Upper Manhattan, a little less than a 5, and Queens around a 5.6 cap rate. These are the statistics for this year. Clearly not a usual year, a down year in a way. Vic, what do you think is affecting all these numbers that we're talking about here in 2020?
Well, first of all, I don't think it's any surprise to me, putting COVID and the pandemic aside, that average cap rates have shot up around 75 to 100 bips, primarily because we underwent a pretty significant change in legislation with HSTPA in 2019. So I'm not surprised to see the data coming in, even though it's a smaller sample size, because like you mentioned, volume is down the most it's been in almost a decade. But another factor that's on the top of a lot of investors' minds today is vacancy. And it varies a little bit by borough, but certainly it's the largest amount of vacancy for market rate units that we've seen, for as long as I've been in the business, 15 plus years. And I think for as long as a lot of people have seen, this is more vacancy than they're accustomed to. And we actually started looking at some data, scrubbing a sample size of close to 1,000 units, I would say, throughout the boroughs, and average vacancy came in around 11%. Now, it does vary a little bit by borough. What we found is that Brooklyn and Queens is a little bit more sticky of a location compared to Manhattan, which is not surprising because of where physical occupancy is in the office markets and the fact that companies are probably not going to open up in full swing until sometime into late 2021. But vacancy is definitely something. And when you talk about vacancy, it just naturally goes to where market rents are going to land. And with concessions being given close to 2 months on average, that's a pretty significant shift. So you have a bunch of different factors affecting volume, the uncertainty in the market, and also the challenge in solving for some of these assumptions like market rents and where vacancy will ultimately land.
Pricing discovery, absolutely. And you and I are in a few deals that need that pricing discovery. And one of the things that you and I speak about often is financing. And clearly today, a lender wants to see everything, especially if it's a free market building. They want to understand the vacancy. There's retail. They want to understand if there's a tenant. And there is some level of escrow, usually 6 to 12 months, that I call a COVID type escrow that we're seeing here. I think you mentioned the HSTPA, which is the act of changing rent stabilization of last year. I think you're absolutely right. That affected rent stabilized a lot more than COVID. And what's interesting is that what we're hearing today is that collections are surprisingly higher than expected in rent stabilized market, in the rent stabilized units, and the vacancy is extremely high for free market units. I think the average that we've seen is about 11% based on our sample. some landlords are telling us that it's a little bit higher. I think we're getting towards 2021 now. And I think many of our clients are asking us, what's going to happen? Where is going to be volume? And what do you think pricing is going to look like? And at the end of this, we'll talk also about opportunities. But what is your feeling, Dick? Where do you think we're going to see ourselves in 2021 from a New York City perspective?
Well, first, I guess let's start with volume. I think 2020 is an atypical year, clearly because of what's happened. So I do expect that volume will pick up a little bit in 2021. I don't think that we will be back to levels that we've seen in 2015, where it was over $60 billion annually, or 2007, where it was over $60 billion annually. But I do think that it will be higher than the 16 billion that we're trending on in 2020. And what I expect is that it will probably fall more in the 30 to $40 billion ballpark annually across the city. But that's just a prediction. In terms of values, I expect that there'll be increasing pressure on some sellers to actually go out there and meet the market. I think some of the cap rates that you've seen so far will probably be higher into 2021 as the pressure mounts from lenders, from investors, increased expenses, higher taxes. So I think pricing will probably get better for buyers in 2021. Inventory will pick up because people will have to do something. You know, if you remember, Shimon, we talked about this for years now. I mean, by virtue of the purchases in 2015 and 2017, we have a wave of maturities coming up, and the values are just not there anymore, right? So I think these operators are going to be in a conundrum where you're facing a cash-in refinance or sell at a loss, and I think a lot of them will choose the latter, and you'll see volume pick up because of that.
Yeah, I think these are great points. And I would add to what you just said at the end. I think that people will face different valuations on rent-stabilized apartment buildings. And one of the things that you and I are working on is also recapitalizations. I think these will happen as well as we move along and people need to refinance. What you said about the volume is extremely interesting, because if you look at 2011, we had about 17 or 18 billion dollars, and I think that's what you alluded to. In 2012, $30 billion, and so 2021 is going to be anywhere in the high teens. 2022 has an optionality of being closer to the $30 billion range, but we're hope to inch up and not down. And I wanted to ask you, where do you think, Vic? I mean, you're asked this question every day. I know we're asked this question a lot. Where do you think is the opportunity moving forward in 2021 and beyond? Yeah,
it's a good question. And you've heard me say this before. First, I'll just say I'm a big believer in New York City long term. I do think we're in for some near term pain and twists and turns, but I am optimistic about the city in general. And you've heard me also say this before, that I'm a big believer in responsible, affordable housing ownership. And I think that everything that's happened, the trauma that we've experienced, has even shined a more intense light on that if you're a responsible operator and you have a longer term horizon and you're looking at affordable housing, which has an element of downside protection. Yes, it doesn't have the upside, the pop that value add operators were seeking so much in 2015, 16, and 17, but it does have, good real estate in many cases. It has the ability, like you said, to be financed. I mean, these are the type of product today that can be financed at 10-year interest-only money, sub 3%, and lenders are actually bullish on it, as opposed to the product that has market exposure. So again, for those that have a good platform, can operate buildings responsibly in a longer term horizon, I think affordable housing does present an opportunity. Similarly, and you might be surprised to hear this, or maybe not surprised to hear this, I do think that rent stabilized product offers a little bit of opportunity because it doesn't have that market risk. And it's gotten beaten up pretty bad since HSTPA, or even before HSTPA. But in a sense, I'm throwing out that upside out the window, and I'm thinking more about the downside protection. So you have predominantly rent stabilized property, or 100% rent stabilized property. you've probably experienced pretty good collections during the pandemic in 2020, stronger than what was expected. And if you, as long as you're disciplined with your underwriting and take into account increasing expenses, a matured tax load of around 30% of AGI, and if you have a property that's collecting well and you don't have high rents and you're not exposed to the market, that's another thing that can be financed well. And again, as long as you have that longer term horizon, that's a product that I think should be appealing to a lot of people.
I agree with you wholeheartedly. I think that the last comment about rent stabilized is also interesting because it's going to be very sensitive to interest rate, and right now is very advantageous. Interest rates in some extreme cases are below 3%, in some less extreme cases are around 3%, and this is really inexpensive money, and it helps increase the value of rent stabilized units, as they are very, very sensitive today to interest rate after the change that took place. I think that you're right. I think that we have affordable, we have rent stabilized, we will have some note sales, we will have some distress and recapitalizations, and these are 2021, 2022, and possibly 2023 opportunities that we hope to help people with. Anything to close this off with, Vic?
No, I mean, last thing is that I do expect that from now until the end of the year, we'll be pretty active in our market. I think a lot of people will try and ultimately not consummate transactions, which is a trend and not surprising given all the variables that are circulating right now. But I think it will be active in terms of price discovery, something that we've alluded to in the past, and everybody looking at inventory and trying to see where they're comfortable. So it'll be a busy, last quarter. Let's see how much of it actually gets executed on.
Excellent, Vic. Thank you so much. And I want to also, Vic and I want to thank everybody at Ariel Property Advisors who's involved in this great research and putting together these fantastic tools for us as brokers and for our clients and for you guys to review. So thank you so much for this, and see you soon.
Bye-bye.